Welcome back. This is Mike with Replicons. It's May 17th, and we're going to look at the market today. We're going to look at Bitcoin, but we're going to look at it in a completely different way. And I want you to pay very close attention because what I'm going to show you today will probably change the way you look at the market completely. Okay, so let's take a look at the upper panel here on this price chart. We've got Bitcoin futures, and we've got an indicator called expected move. What does this indicator tell us? This indicator is based on implied volatility, and that's why we're actually using the Bitcoin futures, because the Bitcoin futures contract is one of the few symbols in the crypto space right now that gives us implied volatility data. We even have options, but what this indicator does is to actually look at the implied volatility in the contract, the underlying contract, the futures contract. And then he does some magic with the numbers and calculates the weekly expected move based on the implied volatility at that time, if that makes any sense. So every Friday, he looks at the implied volatility at the close and calculates the expected move for the coming week. Now, how does it do that? All right, let's go back to our trusty bell curve. All right, not sure I'm going to draw it as nicely as last time, but that's got to be good enough, okay? So if you remember, we talked about one standard deviation last time, 1 sigma. What this tells us, these lines are missing right here. So we've got one standard deviation up and down. And this tells us about 68% of the time what price is expected to do. Well, how does it know that? Well, it doesn't. It doesn't. So how does it derive that range? Well, it gets it from implied volatility, and implied volatility, again, is based on price action. It's not that there's a secret cabal of futures traders that sits in a room smoking cigars, drinking whiskey. I mean, that would be cool, right? and they decide what implied volatility is going to be. No, it's the opposite way. It goes the opposite way. Price action determines what implied volatility is, because the way the futures contract is priced defines the implied volatility. So if all of a sudden there's a surge in pricing of a particular contract, then implied volatility will go up. If price slows down slowly, if there's less volatility in the price changes, and if there's also a smaller range in the price changes, then implied volatility will be affected, if that makes any sense. Okay, that's in rough terms. So by implied volatility, we can derive a lot from the market, because it's basically telling us what the market thinks about the future. Well, and not just me or you and a dozen other people, but millions of people who are traders. And so collectively, it's like a poll, right? It's telling us what collectively the market tells us about the future, but at any point in time. So every Friday, what this indicator does, it looks at the implied volatility of the futures contract, does its magic, and then says, okay, for next week, and I'm going to remove this now so I can zoom in a little bit. So the current week to this Friday, and the close today will determine what the expected move will be for next week. This is actually projected forward based on the current data. It's not finalized yet, so forget about that last one, okay? Right now, what we have here is the expected move range that was calculated last Friday, right here. See that? That's the last Friday contract. Last Friday data. And the market opened actually quite close to last Friday's close. Remember, this is a futures contract. I know Bitcoin is continuous, but the futures contract isn't. So it opened right here. And first day, it actually stayed within that small range. And you see how small that range is. It's very interesting, right? That range was actually quite small. And if you remember the bell curve, right? I think I should draw it like this. Okay. Right? See that? No, that went terribly wrong. Let's try one more time. Okay, I'm trying to draw a bell curve sideways, so sorry about that, guys. Okay, so something like this. All right, this is difficult, but you can see, right? That's what I'm talking about. You see it now. You see it now, okay? I think it's actually a pretty cool way of explaining this. And so this is the range that I was projecting, right? You can see here we would have 2 standard deviations, right? And here we would have 3 standard deviations. And this would be 95%. Yeah. And this would be around 99 point something per night. I think it's 99.5% or something like that. I have to look it up. So that's what we're dealing with, right? And here it's 68, right? 68%. Up and down. Goes in both directions. Okay, makes sense. So there was a 68% probability that we would stay inside this range. Why? Why? Well, because of the pricing at the time. Look how small the range was. We barely moved. Now, is it always right? No. Price can move outside the range. But a lot of times, what it does, it moves outside the range. Let's look at this example here, right? Right here, this one here, this week. See how it moved outside? Here, moved outside, dropped below, then popped back up, but closed inside, right here. Move again and draw again, and so you see that right here. That Friday, we actually closed inside. That happens actually quite a bit. It moves outside the range and then snaps back and remains inside the expected move range. See what's happening here? Here we stayed inside the range. Here we stayed inside the range. Here, this is actually quite interesting. We opened outside the range and actually stayed there the entire time. That's quite unusual, and that usually tells us about the price action. It's not always spot on. And as a side note, when this happens within a correction, and I think we're starting to correct here, it can be an anomaly. And what you usually want to look at is context. What I mean by that is that, look what we did here. So let me explain this by explaining this, all right? Let me explain this here and why we should probably dismiss this for now, at that time, which was smart to do, based on what happened here, okay? Because here we have a similar price range. See that? This here is not atypical, right? We see this a lot in Bitcoin. It spends a few weeks just driving everyone crazy. And then it picks a direction eventually. Here it fell down, actually closed inside. Then here it was also staying within the expected move range, popped back high on that Friday. And then something happens, see? This is interesting because what happened here is that it remained the entire week in the up expected move range. Okay, not a bad start. Let's see what happens next week. So what happens next week here, it stays in the same expected move range, right? The upper range, the upper half of that expected move range. Very interesting. So this is looking positive. And what happens then? It actually breaks out and closes outside, like 2 standard deviations, right? If you're looking at that here, it's like 2 standard deviations that close. And then it opens up the next week again, pops up higher, does the same thing again. Then it flattens out a little bit, but really barely moves. And then it does the same thing again. So this is becoming more and more bullish, more and more bullish. See, I mean, this is crazy right here. This is really when it got to move on. What happens here is that it keeps running higher, 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 and then finally it flattens out. But you see what happens, the way it interacts the entire time with the expected move range. This is what I want you to pay attention to, okay? Let's go through it one more time. This is important, guys. This is super important. 1, well, 1.5, 2.5. I don't know how you're going to count it. I'm just going to point those out. How much time did it spend in the lower expected move range? Not very much through all this, right? Not at all, actually. Here it spent a little bit of time. This is the only exception here. So this one right here is the only exception. And what it does then, here something changes. Right here something changes. What changes? Well, all of a sudden we're spending a lot of time in the lower expected move range. And then we're spending a lot of time in the upper expected move range, actually above it. What's going on here? Well, the market really doesn't know what it wants yet. Right? And here we're in the upper again. And here we're in the lower again. And then we're in the upper again. And here we're in the lower again. And here we're just in the sideways. So what does this mean? We're in a corrective phase. The market really doesn't know what it wants. And it never really actually breaks far outside the expected move range. It stays inside. So it's playing games. It's just pressing everyone's button. Presses the bear's button, presses the bull's button, presses the bull's button again, presses the bear's button, and so on. You get the idea? Okay. And so that brings us to today. And today we're here. And what happens here is that we spend a lot of time in the upper expected move range, and all of a sudden we're seeing a breakout. And today we'll decide, and let me actually zoom in a little bit more even. All right, so we've spent a lot of time in the upper expected move range, and now we popped above. And you know what? We might actually close above it today. And maybe we even close it much higher than today. Then the center of the next expected move range will be wherever this candle will close today. And then we're going to have a range. And the range is not determined yet. So this is not final. So don't take this range as the final values yet, right? That'll be determined by the close of today. So right now, we're back in the upper range. We're actually above the upper range. And this suggests that we could see a breakout, okay? Now, that breakout higher needs to continue. And in an ideal case, what we would see is next week it opens nearby and then remains most of the time in the upper range. If it does that 2 times in a row, that gives us even additional confidence that this market is ready to pop higher and continue higher, okay? If it again does the game as it has before, that it spends a lot of time in the lower range next week, then we might see more price action that kind of presses our buttons, right? Bullish, bearish, and it's not done yet. You can see how implied volatility gives us really important clues about how the market, well, kind of feels about the future, right? And if you just look at the pure price chart, well, that doesn't really tell us much, right? I mean, predicting price action based on drawn lines, yeah, we can. I showed you that yesterday. We're drawing some lines, inflection points. I told you already that we're probably going to see a retest, right? We probably come back here a little bit and retest that upper diagonal that I drew yesterday. It might do that. But at some point next week, and next week is really crucial, it needs to, let me zoom in here, it needs to really break out. It needs to spend time up here. And if it does that, and especially if it closes up here, in this upper range of the expected move range, and the upper half, then we know the market is ready to pop higher. We might see a little bit of a retest, but even if this retest happens, let's say we, as a final thought, okay, this is actually very interesting, so pay attention. It might spend all week here, very bullish, and all of a sudden it drops back down for a final retest. If it does it this way, but doesn't actually close below, by the way, the lower expected move range, it needs to stay inside. If it does that, that's actually a great entry, because the probability from there that it continues higher is actually quite high. Okay? Does it make sense? All right, I hope that was useful to you. See you next time. Cheers.